Hello, everyone. Today on the final bar, we have Bill Baruch from Blue Line Futures coming to us from Chicago. We'll talk about the dollar environment, talk about gold, some areas of the market that I know a lot of people have questions on because there are ripple effects across different asset classes that we can look at. The S&P 500 bouncing off the 50-day moving average in a move that has become very common. If you look at the last 12 months, is this yet another buyable dip? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the technical analysis toolkit, using the power of StockCharts to better understand market dynamics, investor behavior, all of those great things, using the message the markets provide back to us, focusing on the trends, price, momentum, breadth, sentiment, all of those indications that give us some color behind the movements, the flickering ticks in the markets every trading day. When I'm looking at the market right now, we have a familiar pattern. The S&P making new all-time highs, going up to 4,800 at the end of last year, pulling back from there in the first week of trading this year, but getting right back to the 50-day moving average. And I think probably 10 to 12 times in the last 12 months, we have bounced off of the 50-day moving average. One of those times, the bounce did not stay. In September, October of last year, we pulled back a little bit further, but ended up 6% below all-time highs before regaining those and pushing higher again. Is this yet another buyable dip among many that we've seen in the last 12 to 18 months? We'll try to look at some of the conditions together, see what sort of conclusions we can draw. But overall, certainly showing some strength today, led by energy. Now, we have great guests on the show. I'm excited to talk to Bill Baruch here, joining us for the first time. Later this week on Wednesday, we have Dana Lyons from J. Lyons Fund Management. On Thursday, the 13th, Mary Ellen McGonigal from MEM Investments. Then we have a lot of great special content coming up for you around the market outlook sort of period. Looking forward over the next 12 months, what sort of conditions should investors expect? On the 13th, this Thursday, we have Martin Pring's Market Outlook. Bruce Frazier sat down with Martin, had a really cool conversation, looking forward, looking at cycles and economic data, and really, at the end of the day, looking at market trends. So that's coming up this Thursday, the 13th, 4 p.m. Eastern. We also have our main Charting Forward 2022 special series that starts next Tuesday, the 18th. Go to StockCharts.com/2022 Market Outlook for more information on all the guest appearances there. Also, I will be speaking at the Money Show Virtual Expo coming up this week. 7 questions to ask before every trade. We'll go through my technical checklist. I'll share with you what I use, what checks I go through as I'm reviewing a chart and making a buy and sell decision. Hope to encourage you to think about your own checklist and putting some more rigor behind some of your own investment decisions. Go to StockCharts.com/moneyshow for how to sign up for that event as well. Let's continue on with our market recap. As I mentioned, overall, this is a familiar pattern. And 2021, looking back, apparently was a very easy year to invest. And I say that with a great dose of sarcasm because I found it to be an incredibly challenging year. As much as the top line indexes, the S&P and the NASDAQ appear to show these very consistent, orderly uptrends of bouncing off the 50-day for the most part, moving higher and making new all-time highs. Underneath the hood, you had a lot of rotation, right? You had rotation in leadership themes between offense and defense, between cyclicals, value-oriented sectors, and the growth-oriented sectors like technology. And so far, the movements that we're seeing in the first week and a half of trading here in 2022 appears to be more of the same. We're seeing plenty of rotation. We're seeing plenty of choppiness, plenty of uncertainty, and I don't see that uncertainty being alleviated anytime soon. However, the reality of the markets in 2021 was a consistent pattern of the S&P making new all-time highs, a pullback to the 50-day moving average, and with the exception of one time in September of last year, all the other times, this is a fairly buyable dip. Now, what was interesting this week is as the S&P broke below its 50-day moving average yesterday, you had a lot of what are called bullish candle patterns, bullish engulfing patterns, a hammer candle, which is what you saw on the S&P 500. And what that shows is that you open at a certain point, you trade lower, but then by the close, you get back and you regain the opening price. And it looks like a hammer, just like you'd hammer out a bottom. And if you look at the candle chart, you can see it a little more clearly, right? You sort of have the head of the handle, the handle of the hammer coming down. And again, it just means we traded much lower, but by the end of the day, we close back at the highs. And that tends to be a bullish short-term pattern. It tells you the next couple bars are most likely higher rather than lower. And even though we traded and traded a little weaker out of the open, by the end of the day, obviously we pushed onward to the upside. The S&P regaining its 50-day moving average, closing back above 4,700, which is that brown shaded area on the daily chart that we've talked about quite a lot. That was the level of resistance in November and December of last year. We finally broke above that in December. New year, we get right back below it, but now bouncing back there. And that's an idea called polarity, which is a level of resistance becomes a level of support. It's a common technique used in technical analysis. That's why 45.50, by the way, is such an important level. I recorded a video on my YouTube channel called Market Misbehavior end of last week about that polarity concept and why 45.50 is so important, to a lesser degree 4,700. So check that out if you haven't looked at it yet. Looking at some of the other indications of the overall market, you can see the weaker open as we traded lower, but again, pretty quickly regaining yesterday's close. And then from there, just pushing to the upside. The S&P gaining almost 1%, closing just above 4710. The NASDAQ composite even better, up about 1.4%. The NASDAQ 100, 1.5%. The VIX is back below 20, nearing 18 actually from above. Mid caps and small caps both find underperforming the S&P large cap index, but overall finishing the day in the green. Other asset classes, you have interest rates coming off a little bit. Now, again, the 10-year yield's at 175, which is sort of the high watermark for 2021. So the fact that we got above there and got above 180 yesterday was fairly significant. If you asked me overall, do we see higher or lower yields from here? I think it would be hard to expect lower yields overall, just because I think the overall environment we're seeing with the activities of the Fed in the coming months and years certainly suggest higher rates rather than lower rates. And the fact that the 10-year yield is at 175 is a friendly reminder that yields in history have been much, much higher than that, right? We're still overall at unprecedented low levels of interest rates relative to the historical average. However, let's look one day at a time. And today you're seeing rates come off, which was a trend that started yesterday. Dollar index off a little bit, 0.4% weaker. If you look at the UUP, the bullish dollar ETF. Gold price is pushing upwards today with the GLD finally regaining 170. And that's an important move, right? One of the key themes, I think, for last year was, gold really not participating on the upside. Times when you might expect gold to come in as a safe haven didn't necessarily materialize, but you're seeing commodities as a whole stronger in a big way today. Gold and precious metals along for that ride for sure. The DBC, which is the main the main commodity ETF that we follow, up almost 2% today. And the energy sector far outpaced the market and the other 10 S&P sectors, with the XLE up 3.4% today. Cryptocurrencies getting back to more of a risk-on feel as well. Recently, we have Bitcoin bouncing off 40,000, which we've talked about as being a significant level with cryptocurrencies, particularly Bitcoin. If you just draw a horizontal line at 50,000, 60,000, 40,000, 30,000, and just look back, you will find that more often than not, you find significant turning points at those key big round numbers. I don't think that's a mistake. I think that is part of what happens. That's the framework with which humans tend to interact with the charts, interact with the markets, and recognize or expect significant moves at some of those big round numbers. So it's not surprising that they tend to play out. From there, Bitcoin has come up about 3,000 points with the Bitcoin currently trading just below 43,000. Ethereum, by the way, Ether coming up about 5%, bouncing off of 3,000 recently, coming up just above 3,200 currently. On a sector basis, if you look at some of the movements today, it was certainly more of a risk on versus risk off feel to the trading session. By the time the closers register, as I mentioned, energy, the big winner today. And, I think the reality that we're seeing is stronger commodity prices, higher oil prices, and certainly stronger energy. When I screened for stocks making new swing highs for the last time, which was Thursday morning, if I remember right, a lot focused in three particular sectors: energy, financials, and consumer staples. And the last one's kind of an interesting one. Consumer staples traditionally thought of as a fairly defensive sector, which is totally fair. But the reality is you saw some nice bounces there, but especially in energy and financials, two more cyclical sectors, two that tend to do better in a higher rate environment, certainly moving to the upside. But after energy, it's back to some growthy stuff like communication services, technology, both gaining more than 1% today. The only sectors that were down were fairly defensive sectors. Utilities down almost 1%. Real estate and consumer staples just below zero. So overall, this is definitely more of an offensive feel to the day. If you look at the stocks making new highs today, or sorry, the biggest gainers in the S&P, a lot of energy, things like Apache, OXY, Hess, Halliburton, Marathon Oil. Half the names are in the energy sector. And then a bunch of other sort of interesting ones, things like Las Vegas Sands, just trying to regain some swing highs after chopping around, certainly having a tough run of things. And CRL, Charles River, is actually a healthcare name that we've talked about, rotating lower, but a nice bounce off of previous swing lows after a bullish engulfing pattern on yesterday's session. We need to take a quick break. We'll be back with today's guest, Bill Baruch. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we try to make sense of these markets in uncertain times using the technical analysis toolkit. A couple quick comments before we get to today's guest, Bill Baruch. First off, we're going to do a mailbag segment a little later in today's show, and we would love to answer your question in our next mailbag segment later this week. You can get your questions to us a couple different ways. Via email is best. thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions and hope to answer yours live on the air in our next mailbag segment. Also, as a reminder, go to StockChartsTV.com. Our great guest interviews like the one we'll have here shortly with Bill Baruch, great special events like our 2022 market outlook, our recap from last December, looking at the year 2021, and so much more. Go to StockChartsTV.com to use your email address and set up for a free account, or on any of your mobile devices, just search on the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Bill Baruch. Bill's joining us for the first time from the Chicago area. Bill's the president of Blue Line Futures and also Blue Line Capital. Bill, welcome to the show. Thanks for joining us today.
Thank you for having me on. I'm really excited to join you.
Yeah, it's great to meet you virtually, and I've heard very good things and have been enjoyed sort of seeing your expertise in some other places. I'm thrilled that we're able to share it with our viewers here. We're starting looking at gold. Now, gold has been an interesting market we've talked about on the show, which, at times I think a lot of people have wondered when you're going to get that upside follow through on gold, because it's sort of been sideways. Your first chart is looking at gold and some indicators at the bottom. Talk us through this one.
Yes, one of the things that stands out to me, and I will say I'm more of an eternal gold bull, but I do play the market from both sides, and right now I am getting bulled up for this reason. Looking at the indicators below is the commitment of traders, and I maybe I should have provided the chart with a little bit more timeline there, but the what really matters is you can see that peak in the purple line, in the purple blue colored line, is the managed money, and managed money has basically showing that they almost give up on gold. There's very low positioning in managed money, relative to where gold really hasn't, back to when gold wasn't doing anything for years, and managed money in gold has only really two occurrences in 2015. It went negative for a brief time, and then in 2018 it had gone negative for a brief time. Managed money in gold just rarely ever goes negative. So the fact that managed money is sitting down there, it tells me that if gold starts to move higher, you're going to see people. There's a lot of room for people to come in, And I think that could become a very good tailwind for gold. The other aspect here is the red line, and that's producers. You can see that just slowly trending higher. Producers are short because they're hedging out their production. They're closing their shorts out as this thing is over time here, going back to when it set the new record high. So I think that's also notable. Even that little bit of a jump here more recently in the past few weeks kind of shows that producers are they're not selling. They're not making their short position any larger. So I think that's also a tailwind. For gold, or at least the in the know are supportive to gold right now.
It's very interesting, Bill. And that blue line showing the managed money, sort of the anecdotal cash on the sidelines thesis, right? That there could be new capital coming into there. Now, when you think about gold and potential upside, you have to think about the dollar, obviously, because there's a pretty good relationship. Now, this is a chart some maybe not familiar with, the Bund, which is the German bond yield. Talk us through this one.
Yeah, right now, I mean, you're finally seeing yields in Germany come to life. Really, yields around the world are finally coming to life. So in the past couple of weeks, we've seen the yield go from negative 40 basis points to almost zero. And I think this says something here where the relevance to gold, higher yields are a headwind to gold. But the fact that the Bund yield is getting back to zero, I think it brings a currency factor that can be very supportive to gold. And the fact that the gold is priced in dollars. If the US dollar is higher, it's a direct headwind to gold. Typically, days that the dollar is higher, you're going to see, or weeks that the dollar is higher, you're going to see gold under pressure. But if we see this German Bund yield come back to 0%, I think it encourages flows from the dollar and into the euro. So although yields are rising, the currency factor in gold could become very supportive and bring a tailwind.
It's really interesting. And if I could, I mean, I think one of the realities for, just given the strength in the dollar in 2021, a lot of US based investors sort of leaned away from non-US markets, right? Because the dollar is so strong, it doesn't usually make sense to go outside the US. But if we do start to see a change and you see stronger euro, weaker dollar, is it time for US investors to look a little more internationally than maybe they have been recently?
I think that is it's a really, really good point. I think there is going to be some opportunity in outside of the U.S. And I think that's a very, very common notion right now that there are a lot of people expect other countries to outperform the U.S. right now. I think there is one of the tailwinds, kind of moving away from gold here real quick, is I think that COVID in Europe has really, sort of shut down Europe more than we've seen in the US. I think there could be a reopening in Europe that could become a very good tailwind, and that could become a tailwind to these yields ticking up too in the German Bund. So I think that's great to a great factor and a great point you made there.
We only have about 30 seconds left, but what I mentioned, earlier in the market recap, the S&P is sort of this very familiar story of new highs, and then we pull back to the 50-day, and then we just reload and move to new highs. Do you see this pullback so far year to date? And again, pretty early in the year, but do you see this recent pullback as just yet another sort of buyable dip, or how would you differentiate that from something that could be more painful and more dangerous for investors?
I've been saying, going back to the end of last year, I'm well positioned in long this market through portfolios and whatnot. And I've been through our research writing with a bullish bias for I remember how long, but I did point out that when last week or the last week of the year, the melt up, I said, pinch yourself. When we go into this new year, it's the focus is going to shift back to the Fed in the cycle, and that's what we're seeing here. I think the Fed is doing a very good job, and sometimes they have too much messaging, but their messaging right now, I think, is just about right. And I think we could see this Jekyll and Hyde approach where they mentioned the taper, and then they quickly said that the taper is nothing to do with rate hikes. And then all of a sudden, the taper did have something almost to do with rate hikes, and they're going to be hiking rates. And now they're tying it to this balance sheet runoff. But I think that they will use that to their advantage and appear more dovish by pushing back the balance sheet runoff, all of a sudden, like a frog in water, they're raising rates and they get 2 or potentially 3 in next year. I think we're near sort of a peak hawkish narrative. They will ramp up and move this around a bit, but I don't think the market, I think the market will be resilient, to answer your question. You point out that 45.50 area. I think at 45.58 in the futures as well is also a gap from that December 20th. If we break below 4,500, I think you got to become a little more defensive. And I'm already being very selective across the tech space as well. And very, like many people out there talking value and cyclical oriented. So my long-winded answer for you. Sorry.
Bill, I really appreciate your insights. Listen, it's great to have you on the show. We'll look forward to having you back on again down the road a bit. And listen, stay safe there in Chicago. We'll talk to you again soon.
Thank you. You too.
That's Bill Baruch. Bill's the president of Blue Line Futures and Blue Line Capital based in the Chicago area. I love talking the German interest rates. We talk so much about the U.S. 10-year, and it's really interesting sometimes to think about gold, think about the relationship to the dollar, look at some of those non-U.S. rates and how that relates to that. It could be a very different feel all of a sudden if you have rates in Germany going higher and you have a stronger euro, you have a weaker dollar. That's certainly a combination we haven't seen in a little bit of time. So some great thoughts there from Bill Baruch. Let's continue on today's show with our final bar mailbag. As a reminder, we're here to answer your questions anytime. Go to the email us at thefinalbar@stockcharts.com. Let's get to question number 1. I've experimented with modifying my way of ranking stocks, but my new ranking method was disappointing. One reason is that it had NVIDIA over DVN, NVDA over DVN. That's NVIDIA in the tech sector, a semiconductor name, and DVN, which is Devon Energy in the energy sector. Would you please explain what this chart is telling me? And you sent this chart along with you. So this is a ratio of DVN to NVIDIA. So what you can see is, right, in most of 2021, sort of an overall sideways trend to this ratio, but you can see these movements and what this ratio pretty much represents, as I'm thinking of it and thinking of some other charts in the back of my head. You're basically looking at the growth versus value. You're looking at energy versus tech. You're looking at the 10-year interest rate. And I haven't looked at this yet to know whether I'm making all of that up or not, but I'm thinking if I add some of these other indicators will sort of they'll all sort of probably line up in some particular fashion. So we could say we'll say XLK. All right, so what I'm basically adding at the bottom here are 2 other data series which match up pretty closely to the one you're showing me. You're showing me how DVN versus NVIDIA, and basically if you were long NVIDIA, short DVN, or basically just picking NVIDIA over DVN, that did really well into November, but all of a sudden DVN really started to outperform really in the last 2 months, going back to mid-November. If you look, that's when interest rates really started to bottom out. Maybe this ratio actually front tick that just by a week or so. But overall, you can see that the general movements in the ratio that you shared with me pretty much match up with the 10-year yield, right? Rising rates are going to tend to be better for energy and worse for technology, for growth stocks. That's kind of what happened. And this is not just about those 2 particular stocks that you shared. It's also a sector rotation play as well. So the relative strength of energy versus technology matches very well with the ratio that you saw. So it's a common thought to look at 2 names and look at the ratio and think it's one stock versus the other. But you have to remember, you're basically playing a macro theme there. You're playing growth over, or in this case, you're playing value versus growth, and you're playing the interest rate and the shape of the yield curve. And basically the relative movements of energy and technology have matched that sort of change in character of interest rates. So, in general, if you buy into the higher interest rate thesis, if you buy into the fact that the Fed is raising rates, and that's going to put the 10-year higher over the course of the year, then you are fighting against that if you're owning NVIDIA over DVN in that sort of environment. So it's worth remembering the macro impact on some of those stock ratios you may be looking at. Thanks for that question. The next question, a bit of an intro here. If my bond ETFs or my gold funds aren't producing a positive return, I'm told to hang on to them in the name of diversity and to be assured that my drawdown will be less when the stock market has a big dip. It just seems counterintuitive to keep holding underperforming assets. So what if I don't have an industry standard mix of assets? Is my thinking skewed? And your main question was, what do you do with underperforming assets? I think that's one of the challenges to sort of the traditional idea of diversification. If you diversify into a bunch of different asset classes, the problem I have with that is you are by definition diversifying at all times into something that's not working, right? Your goal, and I would say, to be honest with you, if you never want to look at your investment portfolio, something very simplistic like a 60-40 mix or something related to that, where you're looking at equities and bonds and real estate or commodities or something, it's probably not bad if you're not really paying attention at all to your investment portfolio and you're not outsourcing it to someone who can keep their attention to it. But if you are taking control of your portfolio, and if you are making active decisions, I would encourage you to look at books like Quantitative Momentum by Wes Gray and Jack Vogel, Dual Momentum Investing by Gary Antonacci, Greg Morris's book, what is called Investing with the Trend, if I remember right. All of those, the similar, the consistent theme there is the idea of momentum investing or trend following, looking at trends and identifying what the trends are. And instead of diversifying to a bunch of different things, you are allocating to trends that are in play and following those trends. And so, I would say, is your thinking skewed? I don't think so. I think if you want to pay no attention to your investments, pure diversification is probably a fine thing, because then you don't have to worry about it. You don't have to move anything. But if you have at least some time, a minimal amount of time, once a month or once a quarter, to reallocate, I think something like momentum investing can make a lot of sense. Final question, then we got to wrap. Do you use VWAP prices in your process, or have you seen it used to clarify charts? And your comment was, I think you have a breadth of appreciation of different techniques on the final bar. So I thought you'd be a good person to ask. And thank you for that. Do I use VWAP prices? I really don't. And I will tell you why. If I was a trader, particularly a swing trader or a day trader, I would pay a lot of attention to VWAP. And I was first introduced to VWAP when I would talk to guys trading on the floor, different exchanges that would use that, equity traders, or on the main trading floors that would use that to basically measure their ability, see how they were trading around the VWAP. And my time at a big buy side institution, that is, essentially how a lot of traders are evaluated on the buy side at big investment houses, is your ability to execute around the VWAP and buy below the VWAP and sell above it. And that's just a measure of how well you're able to measure the short-term trends. Now, I would say, for a longer term thesis, I really had not used VWAP until I started talking to Brian Shannon at Alpha Trends, who does a really good job of using what's called an anchored VWAP. I have AbbVie here. If I had anchored VWAP and then move it maybe to a recent low. So this is basically taking the October low, and an anchored VWAP is basically, I'm starting to calculate the volume weighted average price as of that major low. You can see from there, we found support a number of times. It's ended up being a pretty good example of the price bouncing off of that volume weighted average price, but anchoring it to a particular price point. That convinced me to pay attention a little more to VWAP than I have. And using ACP, you're able to do that. It's one of the indicators that we have built into the ACP platform. So you might want to check that one out. Look at our help pages, some of the videos that Brian did for us, where he talks about anchored VWAP. That might be a little more helpful to use. But yeah, I probably should feature it a little more on the show. I don't do a great job of that. We need to wrap today's show, go to the 3 and 3. It's about the 3 and 1 now, but we'll get to it. Chart number 1 is the S&P with a percent of stocks above their 50-day and their 200-day. I was talking earlier today with my friend David Sato-Chung at IBD, Investors Business Daily. Does such a great job of describing the market environment in his daily column. And we were talking about this particular chart, which is the changes in breadth characteristics over the last 6 months. What's interesting to me is the S&P has chopped around its 50-day moving average a number of times in the last month and a half or so. The last couple times, it was a pretty low percent of S&P names that were above their 50-day, down to 30% in early December. It's still up about 60%, which means even though the S&P has pulled back to its 50, a lot of individual names are not quite doing so at this point. I think that's an important chart to watch here going forward over the next couple of weeks. Now, the FANG trade has been struggling on a relative basis for sure. And if you look at Amazon, which we talked about, I think yesterday or the end of last week, today we'll talk about Netflix. And again, friendly reminder that Netflix right now is at the same level it was July of 2020. So if you bought Netflix there, you have literally gained zero, while the S&P or the NASDAQ have done much better. So the FANG trade overall has not been a great play, using some of these particular examples that I'm sharing with you. However, Netflix has just gone below its 200-day moving average overall, which is kind of negative. We're nearing the lower end of the range that we've seen over the last year and a half, and the RSI is oversold for the first time since September of 2019. So this is pretty unusual. It's pretty beaten down relative to where it's been. Might be an interesting bounce from there. On the other side, you have stocks like Chevron overbought, meaning they've moved up quite a lot. Could be an interesting counter trend move if you get a rally in stocks like Netflix, a pullback in stocks like Chevron. However, I think the overall trend is certainly favoring the moves that you've seen recently in those names. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the Final Bar. Special thank you to Bill Baruch joining us from Blue Line Futures in Chicago. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.